Mixed but weak-looking jobs data triggered a sell-off in US equities last Friday. So the S&P 500 had its worst week since March as expectations of a 50 basis point cut from the Fed this month ease. So this week, investors' attention shifts to the latest CPI update from the US and the European Central Bank decision. So welcome to the new week of trading with Swissquote's Daily Market Talk. So last week, which had started on a cautious note, ended on an ugly note, really, as the US jobs data, revealed throughout last week was quite weak. But maybe not weak enough to tilt the Federal Reserve expectations toward a clear direction. So to quickly summarize, the job openings fell more than expected in July, remember, and Friday's official jobs data from the US showed that hirings in the US rebounded in August, though not as much as penciled in by analysts. So the US economy added 142,000 new non-farm jobs last month, and the months before ugly figure was further revised down by 25,000 jobs. Then the EBP research computed the rolling 12-month average of job additions in the US, and they came up with a pretty low figure of 76,000 job additions on average per month, but the wages grew faster than expected by analysts. And the unemployment rate in the US fell from 4.3 to 4.2% as expected. As such, the data sure pointed that the Federal Reserve will be cutting its interest rates in a September meeting, but the pricing of a 50 basis point cut fell to 29% from around 40% before the release of the US jobs data. So the US 2-year yield tipped a toe below the 3.60% level but rebounded. The 10-year yield jumped to 3.74%. The 2 to 10-year portion of the US yield curve is no longer inverted, and the US dollar index is better a bit this morning on expectation that the Fed will cut, but not in a hurry and probably not by big chunks. So this is it really. Now, to my surprise, the latter thinking didn't please equity investors much, whereas it could have, really, because, the jobs data from the US was soft enough to back the Federal Reserve rate cut expectations, but not too soft to revive the worries that the US economy is about to collapse, like it has been the case last month, remember. But still, the Dow Jones Industrial Index fell 1% on Friday. The S&P 500 lost 1.73% and recorded its worst week since March this year, while the Nasdaq 100 Index was the most hit by an almost 2.70% drop in just one trading session. And Roundhill's Magnificent 7 ETF fell nearly 3.90% on Friday, and Broadcom, which announced better than expected earnings in the second quarter, but announced also a slightly lower than expected forecast, actually paid the price of that unpleasant forecast with a 10% drop in its stock price last Friday. Rough, right? And the dollar yen, where the unwinding of the Japanese yen carry trades tend to amplify the risk sell-off around the world, fell to the lowest level since August, and the pair is consolidating below the 143 level this morning. And if all that is not enough bad news for you, the data released in the earliest hours of this week pointed that the Japanese economy recovered slower than expected, but that the price pressures remain quite higher than expected indeed in the second quarter of this year, and that inflation in China came in below analyst estimates as well, not helping obviously to reveal the growing tensions about China and a sputtering economy. As such, the Nikkei index is down by more than 0.60% at the time I'm talking here this morning, and China's CSI 300 index is down by more than 1%. And news that China will fully open its manufacturing sector to foreign investors is actually received with limited enthusiasm. just to be polite, and the Japanese investments in China have apparently stagnated so far this year because of slow growth, rising wages in China, falling prices, geopolitics. Well, there are many reasons that actually push the Japanese and foreign investors beyond the Japanese investors out of China. And all the stimulus measures that were put in place by the Chinese government are considered not being enough to bring people, investors, back on board. Anyway, this is how the new week begins on a weak note. So US crude fell 1.75% on the back of the mixed US jobs data on Friday, closed last week below the $70 per barrel psychological level, and will remain under a decent selling pressure this morning in Asia on further bad economic data from China, and the copper futures, which are actually considered as a gauge of global economic health, will also consolidate below the 200-day moving average at the start of this week. The good news is, while US futures are slightly in the positive at the time I'm talking here, hinting that we could see a small rebound after last week's heavy sell-off in major US indices. Now this week, attention will shift to the latest CPI update from the US and the European Central Bank decision. But before all that, Apple will be revealing its latest iPhones, AirPods, Apple Watch, and Apple Intelligence. Today, a new and much anticipated AI toolkit, remember, and every eye is on Apple today, and AI investors are not in their best mood to see the glass half full, to be honest with you. So, coming back to the economic matters and the data and central bank decisions, the US CPI data is due this Wednesday and is expected to show a further slowdown in the US headline inflation to 2.6% in August from 2.9% printed a month earlier. Now, a sufficiently soft inflation data will obviously keep the expectation of Fed rate cuts on the table, but I don't think that it will move mountains this week unless we see a big surprise to the upside, in which case the Fed cut expectations could take a hit. But as the Fed's Waller said, the balance of risk for the US economy has shifted toward the employment side. So investors will be watching the CPI data closely, yes, of course, but they may not make a huge issue out of it. For the European Central Bank, while the market expectations are pretty clear, I guess, the European Central Bank is expected to announce a 25 basis point cut when it meets this Thursday. But what will happen next after that is not so much clear, because the Eurozone inflation has been slowing along with growth in the Eurozone. Released on Friday, the GDP data from the Eurozone pointed at a softer than expected growth in the second quarter of this year due to a prolonged weakness in the zone's manufacturing sector, especially in Germany. Meanwhile, the wages growth also eased in the Eurozone, which is, well, quite a good thing for the dovish European Central Bank expectations. Now, frankly, given the level of dovish Fed expectations today, I think that the European Central Bank does have some more margin, a good room to increase their own dovish bets. So the euro dollar near 110.75 level looks like it could give back some advance if the European Central Bank officials were to give signs this week that the progress in their inflation battle has been satisfactory enough. But what makes the euro, the European Central Bank, those more cautious than the Federal Reserves is that the Fed has a dual mandate. So that means that they must care about the price pressures, but also about the health of the general economy and its jobs market. But the European Central Bank has a single mandate, and that's maintaining price stability. Therefore, while the European Central Bank may not let itself seduce by faster interest rate cuts if the European officials think that there is the slightest chance that we see inflation pick up momentum again in the next few months. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.